It's time to curb our enthusiasm, and I'm saying this because I'll tell you, seeing the 10-year Treasury drop 90 basis points from 5 to like 410 has actually led people go stupid again in some real estate markets. Some of the real estate markets, I'm like, and we're gonna obviously talk jobs and stocks and things in the moment as well, but some of these real estate markets, people are starting to take hard money loans on again, and they've kind of been doing that for a while, but they're taking these 15% hard money loans, and they're speculating that if they buy something now in December, they're gonna be able to sell it for 20% more in March. I'm like, that's not healthy. That's like meme stocks, but in real estate. And part of me is just bitter because people are paying stupid prices on certain properties, and it's like, it's fine. Like I'll keep buying off market or other ones. There are plenty of deals out there, but I look at it because I see those as signs of danger and risk. It's kind of like when you see, meme stocks skyrocketing, like the favorite one that we absolutely tore a complete new a-hole into, which was SHOT. We did an analysis on this one in the course member live stream like 2 or 3 days ago, and we absolutely wrecked this one. I mean, this is just a trash company. Completely trash. Let me put it this way. In case you don't know anything about this company, what does buying amusement park supply chain vendors have to do with women's sexual health pharmaceuticals, cannabis, and detox drinks? Yeah, that's this company for you. Okay, it's a joke. So anyway, look, ignoring that for a moment, it is very healthy for enthusiasm to just stay tenuous a little bit. I kind of, I was thinking about it as somebody who is bullish. I actually don't want the insane euphoria because it makes it harder to buy good deals like stocks or real estate. It doesn't make it impossible, it just makes it a little harder. Let's be real. Anybody who says it's not harder when everybody's euphoric is lying to themselves. It feels easier because you're buying and then hopefully things go up and then you feel like you did the right thing, but you're just part of a mania, right? That mania is actually starting to show in data we just got this morning. Look at this. This is the University of Michigan sentiment. These numbers are absolutely insane. You probably already saw them, so I'm going to save you from just repeating the same thing that you probably have already heard about. But what I really want you to pay attention to is just, first of all, well, 2 things. Number one, this is the preliminary read. So there's a lot of volatility. Every 2 weeks they come out with either the preliminary or the final at the University of Michigan. This is the preliminary read, which is just a way of saying, hey, like, this is just our initial thought right now. This could change. And it does. This does change a lot. But the delta here is insane. The difference or the rate of change that you've seen between sentiment here, not only popping off from last month, which we were expecting sentiment to go up, but how much sentiment has gone up is actually really good. I think what happened is you had Israel lead people think, oh no, the world's over, we're going to go into World War III. Bill Ackman saying rates are going to break through 5%, we're going to have the highest rates ever. And that was a very gloomy time. Remember October? That was stocks down for 3 months in a row. Very, very gloomy outlook on inflation and expectations for interest rates, and individuals' expectations for inflation jumped to over 4%. They were 4.5% in the last read. Now they came in at 4.3. All of these numbers almost instantaneously corrected, which is incredible because a lot of the data that we get really aligns with, we're probably more like in a I'm going to write these dates down because these are very important. We're probably, and I want you to study these, we're probably more in like a 1952, 1983, 1994, somewhere around here. These are probably the moments that we're in right now, maybe even like a 2003. And you'll see that in the data. If you look, you have volatility in the unemployment numbers, which we'll touch on those. You're coming out of a recession. You're coming out of high inflationary times. Uncertainty is still high. I just don't think it's so good to go back to instantaneous euphoria because then we're just going to bubble up again. I actually think the catalysts for a bubble are quite high. Imagine, for example, the Fed cuts 1% next year and starts cutting more solely because inflation goes down, not because of a recession, right? I think we go euphoric. I mean, I think there's a chance we start getting like 2021 pricing in again, especially after inflation adjusted, mostly because the Fed's going to stop vacuuming money. Yields on money markets are going to plummet. When yields on money markets start going down to 3% or sub 3% again, people are going to be like, imagine money market yields were 2.9% and inflation is 2%. People are going to be like, what am I in money markets for 0.9%? They're going to fly right back into stocks. We're going to go right back to euphoria, and that's going to make it harder to build your portfolio. I strongly believe that now, and I've been saying this for a while now, at least a year, now's the perfect time to build and to acquire. Because when it goes nutty again, we're going to look back and go, damn, I wish I bought during the uncertain time. Remember, uncertainty is an opportunity. But anyway, when we look at these time frames, these were actually times where we weren't walking into a big recession. I mean, there's always a recession coming, later in like 1955, 56, you have 85, no, not so much 85. In 85, you had inflation expectations start flipping way down, which was great. The Fed was starting to realize that. It took years for people to get over inflation expectations being elevated and actually their expectations coming down. But you had, 87, 89, volatile, 1991, dot-com bubble, obviously. But after 2003, you had another 5 years to go. So, there's always going to be another recession. I'm not here to say there won't be another recession. I'm here to say that is actually coming in so Goldilocks that there's a chance we're actually going to set up for euphoria again. Which, don't get me wrong, I'll take advantage of the euphoria. But I also, I want this to serve as almost a reminder to maybe take some tendies off the table during the next euphoric run. I wouldn't be surprised if when we get our first rate cut, let's say it's March or it's May, it might be May, we'll see what inflation does. Tuesday's obviously inflation, we'll get inflation data then. I wouldn't be surprised to see some euphoria at the beginning of next year. And it'll start getting priced in very slowly, and people look back going, damn, that came off that bottom real fast. But anyway, these numbers, absolutely incredible, but starting to get a little almost too optimistic. Makes me wonder, we were looking at Delta this morning, and Delta's like, oh, people were spending like crazy. JetBlue wasn't that happy. JetBlue's like, yeah, not for us. We're not seeing that kind of spending like crazy, but Delta's like, there's no slowdown, everybody's spending. Oh, okay. Then let's take a look at another one here. So this is the inflation expectations chart. Obviously, we can see it popped off a little bit after the jobs report this morning. The jobs report this morning is an interesting one. I do think we should understand what's going on with this jobs report. So this jobs report, as we could see, the trend is clearly down on jobs. The longer term trend is about 180,000. Last 12 months is about 240,000. We got 199, which was a little hotter than expected. The big problem was that 0.4% month over month in the wage gains. And there's some issues here because, yes, we had 0.4% wage gains, but we also had a higher paid industry get back to work. A lot of those striking auto workers. We had an employment attorney in the live stream this morning. Remember, I'm live every day totally for free at 5:25 when the market opens up. You're welcome to join on the Meet Kevin live channel. It's linked below. But anyway, we had an employment law attorney that said usually after a strike, you get paid your back wages and you go back to work at a higher pay. And so we're all wondering and trying to calculate, is there a chance that is what skewed the month-over-month read 0.1% higher than expectations? It's really hard to tell, though, because of a labor force of 168 million, even a 30,000 job change doesn't change much. Even if you go big with the hourly change numbers, you're barely seeing a change. So I think it's probably too hard to tell in between the seasonal adjustments and all the other craziness that's going on, how much the striking workers going back had to do with these wage gains. Probably what we're going to have to do is just look at sort of a 3 to 6 month longer term average of what wage gains are doing. And a bigger tell for this economy is really going to be CPI coming out on Tuesday. So keep in mind, on a month-over-month basis, the jobs data feels very, very rigged. We also have some pretty cool indicators. We haven't talked about this one before, but there's this one called the SAM rule for predicting a U.S. recession. And what it tries to do is it takes jobs data and tries to predict a recession to where when the SAM rule rises to a factor of essentially recession with this white bar, you often have a recession. Almost always, actually. Going back to 1950, you've had a recession with the exception of one false positive in the late 1950s, 1959. But right now, or the SAM rule is basically a way of saying, hey, when unemployment goes up for, I think it's like it's on a 3-month moving average, more than 0.5%, it could be a sign that a recession is coming. It's a way of trying to take the lagging employment data and try to make it leading data. And this softening we got today is actually a way of unwinding some of that risk. You can see that right here. Here's the SAM rule a little bit closer. You can see that sort of trend down slightly there. But obviously, it's a volatile indicator. But I mean, you look at the other recessions. You know, we're usually, even at the beginning of a recession coming, we're usually well into the trending positive. I mean, it's very rare that it actually goes down. See over here in 08, it's slowed, but it's just a constant trend up. And then it accelerates as you go into a recession. That's not really what we're seeing here. In fact, what we're seeing here is much more reminiscent to what you got right here in 2011. See, you go positive and you slow. You also got that in 2003. That's why I was kind of suggesting, you know, maybe we're a little bit closer to those other dates that I gave. You could look this up, by the way. Look up real-time SAM rule, St. Louis Fred. You can look that chart up. We're much closer to that 2003, 2011, which is really just post-crisis. And that makes sense. I mean, look at that mid-80s here. These are post-crisis moves. Look at that 77. You had another 4 or 5 years before recession here. You get this increase and then it falls again. So this going positive right here that we've seen is not necessarily a problem. It's, you know, when we really get on this trend up that it's an early indicator. And this SAM rule fired early in 2007 and 8. I mean, it was firing starting in November of 27 and really started going all the way for about a year. And then it just went parabolic. So you had a leading indicator there. I mean, look at the dot-com bubble. You had the leading indicator all of 2001 almost before you got the parabolic at the end of 2001, 2002. So it is a tool that we can pay attention to. So, you know, for me, what am I looking for? Well, I mean, obviously CPI data is the most important. This is the best case scenario for Goldilocks, right? Is that you have employment that stays strong, wage gains that average 3%. That's the goal, is can we get them to average 3%? And then, of course, we want to see GDP stay positive, right? That's the goal for Goldilocks, and that's what we're seeing right now. The question is, can that last under the weight of these higher interest rates? Let's take a look at Nick T, who also gives us these aggregate payrolls, and then he gives us some beautiful charts, as he usually does. Take a look at this. Aggregate weekly payrolls for the private sector. You get the year-over-year numbers as well as the 3-month annualized. We can obviously see this coming back into line of where we are pre-pandemic, which is fantastic. That's the direction that we want to go. As far as wage gains themselves, probably going to have to give it a few more months to actually see, okay, is that 0.4 going to stick? Or are we going to go back to a 0.2? Or are we going to go back to a 0.3? Again, we want to average about 3% on an annual basis for wage gains. Wage gains at 4% is the lowest we've seen in this cycle year over year. Again, though, is that month-over-month number that got people a little bit concerned. We did, on a month-over-month basis, hit 0.2% last month, which could be also because of people being on strike. So we don't know how those seasonal adjustments come into play. Those are all going to be things to consider. Now, as far as Catalyst, CPI is expected to come in flat month over month next, on Tuesday, 0%. Personally, I don't really care so much about the headline number, month over month being 0 or 3.1% headline. It'd be nice if that came in at 2.9. That'd be great. But what I really want to see is housing take more of a toll on this. And I'm pushing for a 0.2. On that core month over month, I want 0.2 instead of 0.3. That'll be much more in line with positivity. But then again, does that lead to euphoria? Who knows? Some will say, I'll just look at the Magnificent Seven. You've already got euphoria. But then again, when you look at the Magnificent Seven, there is one in the Magnificent Seven that isn't euphoric. and that one's called Tesla. So check that one out. So anyway, these are some of my thoughts here. Bottom line, practical implications for this. I would say, look, we're probably in a place where a lot of people are going to start moving from money markets to stocks as this data comes in more and more benign, and we end up proving that we're in more of like I said, a mid-90s or a 2003 or a 2011. You know, everybody was worried about a double dip recession in 2011. It was the best freaking time to buy. So I'm not a bear, obviously, but I also want to be realistic that betting on massive euphoria could happen, but I would at least write down somewhere like, next euphoric cycle, take some profits. Just my take. Anyway, thanks for watching. We'll see you in the next one. Good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.